Video is focusing on IAS 8, and this is on accounting policies. That's what this standard talks about. So our question there says a company began trading on 1st January 2015, preparing a financial statement to 31st December each year. As at 31st December 2015, the company changed the measurement of non-current assets from current costs to replacement costs. If the new policy had been applied in previous years, the company's property, plant and equipment at 31st December 2015 would have been 200,000 kwacha lower than the amount originally calculated. Similarly, the property, plant and equipment at 31st December 2016 would have been 400,000 higher than the amount originally calculated. The company depreciates its non-current assets at 25% on straight-line basis. An extract from the company's draft statement of profit or loss for the year to 31st December 2017 before change in accounting policy is as follows. So these are basically our statements before the change in the policy. Yeah, just take note of the figures so that even as we start changing these figures, you'll be able to tell that, okay, it's due to the change that they've talked about in the earlier paragraph. Okay, then they've told us that it may be assumed that the company's taxation expense is always equal to 35% of its profit before tax. Retained earnings were originally reported to 950,000 on 31st December 2015. Dividends paid were 350,000 in 2015, 150,000 in 2016, and 275,000 in 2017. 1. Prepare an extract from the company's statement of profit or loss for the year to 31st December 2017, showing restated comparative figures for 2016. What are they asking us for here? Here they want us to do, of course, restate the profit because the policy has changed. Therefore, even the profit will be affected. We have to know that depreciation affects the profit for the year. So hence we'll have to start restating these things. So let's go back to the paragraph there. Take note that these changes began when they said that from 2015, they said that this property, plant and equipment figure would have been 200,000 lower. So already, if the value of an asset changes, then even the depreciation will change. So let's say the cost of an asset has gone lower. Don't you think the depreciation will also go lower? Yes. So the answer to that would be yes. Why? DIP is always based on the cost. So if the cost is increasing, the DIP charge will also increase. That's what just happens. They move together, directly proportional to each other. So if the cost of this PPE goes down, equally DIP will go down. So let us calculate the restated figures for 2016 and 17 as they've told us here. Profit figures as they will change. But take note that the 2015 drop in value on the non-current asset will not affect 2016. Why? When you look at depreciation, it's a 1-year thing. It's a per year charge. DIP does not spill over and affect the next year's depreciation charge. No, that's not what happens. Yeah, unless it was something like your closing stock. Closing stock always changes. Like in this year it's closing, the next year to be opening, so it's going to affect the next year because of that fact that it's going to be the opening stock in the next year. So that's the thing about DIP. DIP is just for a single year. That same DIP charge you charge will just affect that particular year. And straight line basis again, yeah, I will calculate this DIP. So it's just like once you charge it to be pay, the DIP pay that will be charging. So I'm telling you your attention to this other one now. The depreciation would have been 400,000 higher in 2016. Why have I started with 2016? As I explained, we are restating from 2016 to 17, and we have said that 200, which was in a change in 2015, it's not going to affect 2016. No, depreciation is just affects a single year and not the years that would come after it. No, that's not how depreciation works, unless the scenario of stock, as I mentioned. So just find the DIP charge, because this is still a value of an asset. They're just saying it would have been 400,000 higher in 2016. So what you just do is that charge DIP because dip is our focus. So we're looking at which one affects the profit. Is it the non-current asset value or dip? The only thing that affects profit is depreciation, not the current assets cost. That one affects the balance sheet or the financial position. Huh? So that's why I want to find the depreciation here. This is going to give you what? 100,000 dip. So this dip, having known that it's the charge that would have been, having known that this asset should have been higher, meaning dip should have also been increased by what? By 100 further, because even the value of an asset has gone up, even dip would also have to be increased. Now, what would be happening to your profit if depreciation increases? This is your next question. What would happen is that if dip goes up, your net profit will reduce. It's just as the effects there. It's like you're trying to increase more expenses, huh? And with the more expenses you increase or you add on, you're reducing your profits. That's the understanding. So remember that your profit in 2016 was 19 initially. What you just do, just remove that 100. You're left with how much? 18. Okay, this becomes your profit before tax. You're just changing the profit before tax before charging any taxation on it. First, you change the profit before tax because that's what they presented to you here in the statements initially in the question. Then you change that, and what's the tax charge? 35%. So basically, the difficult part was just on changing this, and once you change this, the charge of the tax is not difficult because tax is always charged on the profit before tax. This one is giving me 630. 630. When you subtract, what are we getting? So this would give us 1170. Done. That's your basically your profit after tax. You have done 2016. 17, by the way, should even be indicating your years in the as you're answering, huh? In your exam. This is 2016. This will be 2017. Next to 2017, what was the profit? It should be 26. Let's confirm. So you'll notice it's 26. That's the profit before tax in 2016. 2017, I beg your pardon. But the only thing is that in 2017 there was no change here. They didn't talk about any change in 2017 on the value of an asset. It was just quiet. The changes ended in 2016. But you also just have to show if there was going to be a change, you would have shown it. But in this case, just rewrite 2017 because they've also asked you to show it as well. So just rewrite 2017. So you just put in your 26, your charge tax, because there's nothing that's going to change here. So basically this is like your initial profit before tax. That's okay. We know there's no change that's going to happen on this one because there was no other difference in the assets value. What's the tax on 26? When you charge tax on the 2600, you should get 910. Less that from 26, what are we getting? 1690. Done. That's basically the profit after tax. We have answered part 1 just like that. 2. Calculate the company's retained earnings at 31st December 2017 and the restated retained earnings at 31st December 2015 and 16. So we're going to start restating. Why are we doing this? There's a change in policy. The rules state that if there's a change in accounting policy, we follow a retrospective approach, meaning we go back to the earliest period given, being 2015. That's why we start making the changes from coming forward, and that's what we're going to do. Usually when we take this on the retained earnings, when calculating the restated retained earnings, we take that retrospective approach that I've just explained. So let's start. What were the initial retained earnings? 950. Check them. They're just saying that the retained earnings were originally reported at 950,000. Don't forget their dividends stated as well in this question. What do we do with dividends? Dividends are usually subtracted, and that's what we'll be showing even in our calculations that will start coming forward. So what you're going to do is this. You start with your 950. You indicate it. Just call it retained earnings. I'm just abbreviating due to the space here, but you should write it in full in your exams. Then the next thing is that you say change in policy. That's the next detail. Well, the changes, have you noticed from the question that in 2015 is when the changes began to occur on these assets, that it should have been 200,000 lower. What is that going to signify? meaning the asset should have been 200,000 lower, therefore even depreciation would also be lower. As I said, they are proportional to each other. So therefore first calculate the dip on the decrease of this same value of that asset. So what is 25% of this figure? Are we going to get this is actually going to give us 50,000. Okay, that's your dip. Now you have your depreciation. What did we say? Ask yourself, does if dip was, in this case dip was supposed to go down, huh? If dip is reducing, what happens to the profit? It's an increase. It's opposite, huh? When an expense, dip is an expense. If an expense is reducing, you're actually increasing your what? Your profit. So it's that opposite effect. So what you're going to do here is that your profit has to have been increased or pushed up by what? By this same 50 in that same year of 2015. Although they haven't told you the profit in 2015, don't worry about that. You should just know in your mind that this 50 is what should have pushed up the profit, since an expense was reducing by that same figure. So the only thing they just advise according to the rules is that take that new change that would have affected your profit after tax, then put it to retained earnings. So we have said a lot of things. Huh? This same 50,000, we found that that's a deep charge for 2015. That's a new deep charge, which should have been what? Lower, according to the decrease in the asset. Now we said that since there wasn't a stated profit in 2015, just know that if an expense was reducing, therefore you are increasing your profit, and profit is what usually you get to add to your retained earnings. Those are the rules. But the thing is that the profits increase or change in the profit should always be after tax. Those are the rules. So we said this 50,000 would have pushed up profits upwards, as I said. So you're just going to take it after tax. The tax is 85%. So we just use this fraction 1 minus tax to give you an accurate after tax figure of 32,500. That's the one you're going to add on to your 950 that is waiting here on retained earnings. 32,500. That becomes your what? Your new restated balance. That's what you call it. So this is 982,500 as the what? Restated balance. Such you call that restated balance. Then that's just for 2015. You've restated the balance for 2015. Then go to 2016. We're doing all the years they've mentioned to us. Just go and call it restated profits. You bring it in. Restated what? Profit. From which year? 2016. You even put the year 2016. What was the figure in 2016? Profits 1170. Why have I picked 1170? You always pick the profit after tax. Always. You know, when you're adding anything in a retained earnings computation, always take the figures after tax. Hence, we're just picking the profits after tax for this other year, which is 2016. That's why we call it trying to put into this computation. So you put in the profit after tax. Then remember there were dividends. Dividends are supposed to be subtracted. So why haven't I subtracted the depreciation in 2015? One might ask. This is because that's for you to have been given a retained earnings of the same year 2015, then it is understood that dividends have already been taken out. So when you have been given the same year retained earnings, same year dividends, we just ignore the same year's dividends because it's like they've already been taken out in that retained earnings of the same year. Unless these are the years that are coming through, which is 16 and 17. So you do that, less your dividend of 150. What are we going to get at this point? So you have your 982. Start from the 982 to calculate that. 982,500 plus 1170. Okay, minus 150,000. 2 million. Yes, I'll just erase this. We'll continue on top. 2 million and 2,500. This is the answer I'm getting. What do you call this? Restated balance of what? 2016. Then you go to 2017, bring in again the restated profits. So basically, in the retained earnings calculation, you're just bringing in the profits which are being restated. That's what you're just doing here. The restated profits in 2017 was this. If you remember, after tax as well, always take it after tax. 1690. Then retained earnings were how much? 275,000. Always subtract. What are we going to do here as well? What total are we going to get here? So 1690, then minus 275,000, 3,417,000, 3,417,500. Done. So then you just call this restated balance as of 2017. Then you're done with doing that part B.